Big welcome to our live audience for the Digital Health Investor Talk show. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me on x.com/Stephen Wardell. Our show today is on the topic of why so few good exits in digital health? And our guest is Steve Rubis. Steve is the chief of staff at Access Telecare, a telehealth company, and he was formerly a digital health equity research analyst on Wall Street. You can follow him on LinkedIn and on YouTube at Mr. Investor Relations on YouTube. This show is being recorded and will be included in my podcast series called the Digital Health Investor Talk Show. Subscribe to our podcast on Apple and Spotify, and we appreciate every review. We always love seeing those 5-star reviews as well. We have new podcast links for the show, so make sure that you see recent episodes when you subscribe, or you could be on the old page of the old podcast. This is not investment advice, and we are not investment advisors. Here's the format of today's show. The show is 90 minutes long, and Steve and I will spend the first part discussing the news and the macro picture and some other topics, and then we'll focus on our special topic of the day. And we'll be taking your questions throughout the show in the LinkedIn text chat. So you're welcome to throw questions in the chat. So Steve, welcome to the show, and please introduce yourself to our audience.
Yeah, thanks, Steve. Excited to be here. Steve Rubis, currently chief of staff at Access Telecare. Do a lot of board material, board narrative prep, and strategic finance, so think forecasting of the business. My career sort of spans Wall Street equity research, where I covered U.S. internet, Chinese internet, and digital healthcare as a contemporary to Steve, and then spent a lot of time in investor relations. I've run investor relations for data center REITs, Caesars, the casino in Vegas, a biotech, and Access Telecare when we were a publicly traded SPAC. So hopefully I can give some good insight, having been on both sides of the fence here as an analyst and now someone who acts more as an operator, and just excited to be here with the group and share thoughts.
That's great. Thank you. So I'll kick it off with the macro news. So our audience is young company leaders in digital health and investors. And we used to not have to worry about the macro news because it was always just fine. But these days, we have to care about things like market index levels, inflation, interest rates, jobs, and unemployment, and what the future holds in store for us. In the last few days, what we've seen is that ADP is the biggest manager of payrolls, and they publish data about jobs that Wall Street takes very seriously. And so they came out with saying that there were 37,000 new job starts in America that hit their payroll service in May. And this was seen as quite weak. It was seen as one of the weakest numbers in 2 years, since 2023. And so I think the market's concerned, but the NASDAQ is up today despite this. And this led to Trump calling for the Fed to cut interest rates. So what we've seen is that the Fed sort of signaled a year ago that it would cut interest rates and even use some aggressive language. And since then, they've only cut interest rates a little bit. And the obvious reason why it's less than we expected a year ago is because they're still concerned about inflation. That one way that the Fed can control inflation is to have high interest rates. And so the Fed is reluctant to cut them because they're still worried about inflation. And so this is a real trade-off. But when I think about young digital health companies, I have to take the side, I think, of cutting rates. So I would stick to the Fed's original plan and be more aggressive on cutting rates. And Trump is criticizing, and Trump would like to see that too, not for the digital health sector, but just for the broader economy. He'd like to see some stimulus in the broader economy. And he thinks that one of the levers that he doesn't control is for the Fed to cut short-term rates a little bit. So I give the Fed a C on this. And then the next Fed Open Markets Committee meeting is in mid-June. So, Steve, any thoughts on the ADP jobs report and the Fed cutting rates?
I
try to speak from the perspective of young digital health companies, not policyholders or the economy as a whole.
Yeah, look, I think it makes sense. I think, for anecdotally, my angle on the jobs market is more from like investor relations. And, what I hear anecdotally, having just been at the National Investor Relations Annual Conference, there's not a lot of jobs out there. So I think from that standpoint, I'm with you. I think you need to be cutting rates. I mean, the Fed clearly is sort of between a rock and a hard place. And the other anecdote I would give is, through my travels on LinkedIn, is you see, unemployment's at all-time lows when you look at the actual reported percent. But if you consider like underemployment or people who've had to take like washing cars at Hertz or or working as a barrister, unemployment would be closer to 20 or 25%. And I think that's where, with you probably need to be looking at cutting rates here.
Yeah, and in the world of digital health, you're talking about people, talented people who have chosen to put their career in areas of exciting products that advance healthcare that are intrinsically risky. And so you have two mid-career professionals. One goes into the innovation division at pharma, and the other one goes into managing an off-patent drug that has flat sales. And then during the tough times, the innovation jobs get cut, and the guy who's a product manager for a generic drug, his job doesn't get cut. But the people who so it's sort of like no good deed goes unpunished, and then all the innovators are cutting their jobs at the same time. So what's your next move exactly? You can't just move from Novartis to Sanofi or something. So yeah, so it's a tough time. And so the next topic is the big beautiful bill. So it's very topical right now. It's advancing through both houses of Congress, and it includes a lot of new spending. It extends tax cuts, which is treated like new spending because the Congressional Budget Office was anticipating tax rates would rise back to former levels. So it extends temporary tax cuts and it adds new spending. And this is exciting for Congress people to bring more spending back to their district. And it's exciting for people who take government money to get more government money. But it's also seen as budget busting, which is very concerning for the U.S. fiscal future, and makes people concerned about kind of out of control debt and inflation in the future, monetizing the debt, out of control debt and inflation. And this has caused long-term bondholders to demand higher rates. And so we've seen those rates go up for the 30-year Treasury, which in turn is very concerning if the government can't refinance its debt or can only do it at high interest rates. That's huge amounts of government revenue going out the door to pay interest rates as we refinance long-term bonds that come due. So this is bad news. And I think Trump and his team are trying to find a compromise position where they don't have to monetize debt, they don't cause interest rates to rise, they get economic growth going, but it may be really tough, and we may also be sliding into a recession as well. Any thoughts on this, on the big beautiful? And we also had Elon Musk, who ran Doge for the government, has now come out denouncing the bill. So he was scheduled to exit his volunteer job for the government after like 100 days or something, and he did do so. And before that 100-day mark, he shut up about the bill, and then after it, when he officially left his role, he has criticized it for lavish, excessive spending that is fiscally unsound. Any thoughts on the big beautiful bill and what it means for the economy and digital health?
Yeah, I think it boils down to one word for this audience: liquidity. And if you're an operator, you really need to be focusing on how do I get to net income positive? I know, like for us, the task was first task was adjusted EBITDA positive, then it's net income positive, and now it's unlevered free cash flow positive. So I think if you're an innovator, it's time to tighten the belts, especially if you're worried about capital raising. You want to extend that runway as long as you can. I don't know how any of this will settle in terms of the government, but it clearly suggests there's a lot of disruption or displacement in some way looming. And so you want to make sure that you're planning for the long term and have liquidity in case something happens over the next month or next year.
Yeah, and I'd add to that. So, Trump has come in with a very different agenda. Usually, Republicans and Democrats have similar agendas, and they make a big deal of differences during the campaign, and then they wind up having similar agendas. Um, as one example of that was that Obamacare was implemented, and then Republicans promised to reverse it and didn't when they had the opportunity. So we get more continuity than change. But Trump really does mean change, and so this is causing uncertainty. And so you might have that Trump says that we're going to cut pharma prices. Well, pharma doesn't know what to make of this, so pharma feels poorer and they spend less on tech. They spend and budget holders in pharma look to cut back 5% on their spend on tech. But for young tech companies, that's like having revenues postponed a year and cut 50%. So the way that it ripples down, it might be 5% for pharma, and pharma will bellyache over that. But then it's a huge cut for innovators.
Yeah, exactly. It's just the tariffs and all of the stuff that's going on in the government is just causing like a pause, or I don't know, there's probably a better word for it, but it just seems that it's frozen the market once you go lower from that macro level of, say, large pharma or large healthcare. And clearly it doesn't help when you see some of the issues that UNH is dealing with, or some of the other large players in the other sectors, because you think of it as I think it was the four Ps, like the payer, the provider, pharma, and patient, and the money was always at pharma and the payer. And if those two entities are having trouble, you're seeing it when you look at like ICLR, you look at their guidance for the year. They gave a large guidance range. It was almost 600 million wide because it's an $8 billion revenue company. And to the sharps, that's signaling, hey, we're setting up for a lower number by the end of the year as we work through the four quarters, and we're trying to lower expectations without destroying the stock price. And I think that's the concern. Like, you're seeing it across the CROs. There's some struggle there, and if you're seeing it there, that's suggesting there's some trouble in pharma, as you've described, and then again with UNH and some of the other macro stuff, whether it's the Medicare Advantage news you're hearing, or some of this stuff where providers who don't get paid or get rejected from the system may be able to adjudicate those claims and get paid at a higher rate or a multiple of what the original cost was. There's just a lot of disruption right now, and so that's where it's hard to bank on, hey, I know these guys are interested, but it's hard to say I'm going to sign this in 3 months. It may take 6, or your sales cycle. There's a favorite buzzword of Wall Street. Your sales cycle is kind of elongating given all this government uncertainty.
Thank you. Yeah. And so we have a couple comments from the audience. One is Kimberly mentions, aren't we headed toward the highest inflation since 1981? So yeah, Kimberly, so I don't know the latest data that could be, that's interesting. So I think we have, on the one hand, we have tariffs, which could be highly inflationary on the one hand. And then on the other hand, we have a promise of lower energy costs, and that lower energy costs is usually through greater energy production. That's usually disinflationary. Energy is a really big factor. And then we may be heading into a recession as well. And recessions makes everybody feel poorer and spend less, and buy less and spend less. And that usually sort of nips inflation in the bud. So that's a good question. And then Joe mentions that the AI wave is causing layoffs and backfills across all industries, and I think that's starting to hit, and we're seeing the number of people. Job hunting is increasing month over month at an alarming rate. It's a reset of the workforce, and the new flex for businesses is revenue per employee. So that's interesting. And usually we think of, in healthcare, in order to double revenue, you need to roughly double employees in healthcare services, not in software. And so that may be changing. And I think there's some interesting metrics, like one of the greatest ever revenue per employee companies was the young WhatsApp, bought for billions when they had like 50 employees or something like that. And today they're wondering, when will be the first $1 billion one employee company?
That's
The
hard.
question on people's minds.
It is. It seems like a race to like scale, meaning like it's this race to like a handful of billion-dollar companies. But I love these comments because I think what you're saying, it's hard in healthcare to kind of cut people, because I think one of the struggles is everybody wants to say, hey, we're just going to make a tech solution and put it out there. But unless you've worked in this industry and have tried to sell to a hospital or sell to a provider, you don't realize that, hey, the most obscure discharge nurse in an ER can torpedo your technological solution. And so if you're not bringing her donuts or Starbucks or there to say hello, your technology may get ripped out, even though the CFO or the service, the hospital person wants you there. And back to the inflation topic, I think it's great. I like the comment that you brought out there. I think the hotter take on it, I would agree with Kimberly's comments, and meaning that if you read Lionel Robbins' The Great Depression, it's a great book about the depression of the 1920s and 30s, and the comment in there is, when you're in an environment where you're getting significant productivity gains, but prices aren't going up, you're actually in a very inflationary environment. And that was the environment we were in going into COVID. And then we sort of ripped the Band-Aid off of inflation. And it's just been, in my view, I feel inflation has been a lot hotter than what the economic reports suggest. And you just see it in housing here in Chicago. You see it in housing in Virginia, the two markets I'm most knowledgeable about. And then, you look at the fact that no one's making more money and no one can kind of move jobs. It's a tough market. And I think that to round out that thought, like, when I think abstractly about where we've come from Volcker and having to take rates to 18% to kind of break inflation, my concern has been, do we need to take it above 18% to break inflation today? And when you say something like that, people probably think I'm crazy. And I think it signals to you like there's not a very strong impetus or interest if that is the solution to even enact something like that. I think that austerity measure would be so difficult that I think that's the struggle. And I think that's where you're seeing the push the can down the road and kind of pushing on a string and why the job market isn't working. Now on the AI comment, I'm not so sure AI is really fully resetting the job market or taking jobs away. I think it's certainly a tool that's hurting job seekers in getting jobs because if you're not able to game the system in some ways, at the conference I was at recently, recruiters were saying for a very specialized investor relations role, like say SVP of investor relations at Cerner, they would get resumes for a dog walker. And because you can AI and just robotically set up your job search, like there's no reason. Or I think of an example. Vail Resorts was looking a year or two ago, and they got 600 resumes the day before Thanksgiving. There's not 600 people in the U.S. who are looking or qualified to take that job. So that's where I think AI has been a problem. Is it's made it harder to be efficient at what you're doing because you still have a lot of the errors in AI that it's not always accurate or it's not always pulling the right data. So I think for me right now, the AI is more that's making people somewhat harder or less efficient at what they're trying to do.
Yeah. And so you have AI generating content, and then we're lagging in the AI filters that filter out the content we don't want to see. And so it's an AI battle. So let's see. I'm going to speed up a little through this macro news section, but I'll just mention that the Nasdaq is back up at 19.5 thousand. So that's where it was a few months ago. It was at 17,000 a few weeks ago, and people really felt that. They felt that decline to 17,000, and thought that was very concerning. And so I am surprised that we're back at 19.5 thousand. And I think part of it is that the tariff war was a shock. Now there are Wall Street commenters who are and the tariff war was a shock, and it caused a lot of uncertainty. It caused stock prices to pull in, and now stock prices are back up. So why would that be? And I'm hearing from Wall Streeters that it's because of the taco effect. So the taco effect is that Trump always chickens out, TACO. And
I
what
like it.
that means is that Trump, he's noisy, he's angry, he is calling people names, he is saying that the other guys are bad guys who've hurt us or whatever, and then he takes a very aggressive tariff position. But then he is always delaying implementation, or he's striking a deal that wasn't that different from the last deal, and it doesn't address the points he was complaining about before. And so that's what they mean by chickening out. In other words, that we're not facing 30% tariffs across the board with 100% tariffs for certain countries, certain major countries. This is just positioning, and we're not going to be hit by the shock of actual very high tariffs. Positioning to strike a slightly better deal. So in other words, an actually modest ambition. I don't know what
Taco
you
is
think
a
about that.
it's a great excuse, I think, if you're talking to a Wall Street or especially a sell sider, because and I think this is a great educational thing for this group. Is for me, I like to look at consensus and look at consensus of different companies to determine where the market's going. You look, Delta's pulled guidance, ICLR, and some of the CROs are having trouble. Doximity recently had some issues with guidance. Astrana Health is having issues with guidance. And in the discussions I've had with other investor relations pros over this week, my concern is that, and the other stat I'll give you is that when you look at consumer, only 30% of the sell side has adjusted numbers. And in talking to a lot of IROs this week, I would argue that most of the sell side is not adjusted numbers. And I think it's more because we're in this sort of perverted environment where no analyst wants to be controversial because management will never call them again or go on an NDR with them again. No one wants to be that first penguin to say, hey, I'm cutting numbers. And this is actually a time where the sell side should be like, hey, let's cut numbers as low as we can. Let's kitchen sink it, guys. Let's go crazy and like really help management teams reset that guidance cycle. Because by not doing it, I feel like we're setting up for distortion in the markets when we get to January, February, you get your fourth quarter prints and you start looking at reassessing consensus for the current out year that now becomes the current year. When you look at where these market gyrations are, they're too wide in terms of movements to be, in my view, bullish here. I think you need to be more concerned. And it's almost like I view these rallies as like, sell into strength rallies that you see in like bear markets that you saw in 2008 or whatever. And that's not to imply that we're going to have some Armageddon, but it's more to imply that when you see these sizable gyrations, it's not indicative of a healthy market because all those people who didn't sell at the bottom, they're like, oh, I better sell this time so that I don't sell below the prior bottom. And like, yes, the NASDAQ has kind of recovered, but some of the other indices are still haven't really blown through that last relative high. And until they do that, it's hard to say, hey, this is a bull market. And the other point I'll give you is from the investment banking perspective. Like what I've heard from some of the IR people is, the bankers are like, look, once you rip the tariff band-aid, whether he chickens out or not, the damage is done. And you've seen the damage done in the market. And so there's a cycle that it just takes some time to work through. And unfortunately, because everyone seems so reserved or unwilling to do an extreme action, you're going to have a prolonged reset draft of maybe several quarters. And it may take until 26 to get back on track for growth.
By the way, on that tariff news, I actually have friends who are personally moving up their personal tech buys because they're worried that there's going to be a 40% tariff or something on it. So people who have decided they have a 5-year-old personal computer and they buy the next deluxe personal computer now because the price is about to go up. So that's something for the audience to consider. So I'm going to just move to a brief discussion now of the environment for fundraising, consolidation, M&A, and IPOs. So the number of deals is in digital health of early stage fundraising deals is lower and the size is higher. And if the size is higher, that usually means it goes to later stage safer bets. And that's bad news for the innovation economy and the young companies. It's VCs seeking safety. And the consolidation environment has been under consolidation, slow environment under consolidation for a very long time, since 2009 by my measure. And we're seeing it start to pick up just a little bit. We're seeing either sometimes you see wind downs or you see some deals announced. And I think what's happening there is it's a buyer's market. Sellers are not getting the price they want. Sellers are running out of cash if they're not cash flow positive, and they have to sell. And they're not no longer hold out for the very high multiples that we saw from 3-4 years ago. So we are seeing an uptick in consolidation, and I think it's going to further increase in the future. And then IPOs. The IPO window has been closed for a long time, ever since the Fed started hiking rates over 2 years ago. And so we're starting to see some action there, led in the whole economy by digital health. Everyone would have thought we would have seen big tech go public and do well, and then digital health would try to sneak in after them. And instead, you're seeing Hinge debuted at, I think, close of first day was like 39, and they went as high as 42, and now they're down to 40. And so, I say great for a digital health IPO is that it IPOs and the stock goes up 15%. That's great. It stays up. That's great. Going up a little bit and staying up, which is what's happened, that's okay. That's good and okay. And then, if it significantly falls, then that is of concern for the whole sector and makes it harder for other companies to IPO. And then Omada has recently, or there have been repeated news stories over the last week that Omada is definitely going to IPO. So that's interesting. So Omada's treating the IPO window like it's open because of Hinge and following Hinge. And we want this to happen. There's a lot of unicorns we want to go public. We want to see them go public. It's still shaky whether they're going to do well. If they do well, that's good for the sector. Many more will go public. If they don't do well, it can wreck the opportunity for others to follow. So it's high stakes. So any thoughts on, Steve? Any thoughts on?
Yeah, it's liquidity. Although, one thing that sticks out is you think like Hinge is trading it at 23 PE. In fact, that it has a positive PE is like unheard of. But a couple of thoughts here is it's all about liquidity. I think what you're finding in the IPO market, especially in digital healthcare, is the VCs are hitting an inflection point of they know if they're going to IPO, they have to take a valuation discount and they have to determine, okay, is my liquidity paying so much that I'm willing to take that discount to take it public to get a new cash infusion and maybe, exit some of my position and let others into the book of business. And I think, it's important for both of these to do well. I think that, Hinge is set up maybe a little better when you think of the workings of the modeling and guidance from a sell side perspective. My concern with Omada is that it harkens back to Medidata Solutions where the way their P&L is set up, there's not enough discrete data to where the analysts will be able to judge their land and expand campaign from diabetes into the 4 or 5 other indications. But certainly it's an amazing business. We have it as a benefit at our company. So, clearly, a lot of people use it. And The other anecdotes I'll give you is, what I heard this week from recruiters, and then think more like proxy governance or governance types who support investor relations, is the window's kind of moving to the first half of 26. The view is like there's not a lot of job specs that people are working on. And then secondly, the people who are kind of working on the nuts and bolts of governance, putting together that IPO, they haven't been gearing up, and they would be gearing up right now if there's going to be a bolus of names. Now, my guess is maybe or Lyra. I'm probably not pronouncing it correctly. That's probably my guess is the next one. And I would actually argue maybe that one's more of a, not bellwether, but better indicator of what's the health of the market. I feel like Omada's been around forever. So I think it's a very positive sign that they're finally going public. Hinge, like my concern with Hinge is, yes, it's digital health, but it's more medical devices. Like when you think of who's going to cover it, it's probably your med device analyst, not your digital healthcare guy. When I was doing this, I wanted to cover Dexcom. Like one of my best stock calls ever was Dexcom, and I didn't get credit for it because I couldn't cover it because I wasn't the med tech guy. So I think that's where Hinge kind of falls here, and they benefit from having that device versus the services over at Omada.
Mm-hmm. Interesting. So now we'll move on to the next part of the show, which is future administration policies. So we know that Trump and RFK mean change, but we're only hearing about it in drips and drabs. I know that a couple of weeks ago, Trump said that we're going to have most favored nation pricing of drugs in the U.S., which means pharma prices are going to come down. And I thought that from a pharma perspective, and I don't work in pharma, that was an emergency for pharma. And I talked with pharma people, and it was a big news, but it was not an emergency to them. I don't know why. Maybe it was the taco factor that they didn't think it would actually happen or something. So, Steve, do you see in the last couple of weeks any administration policies that affect healthcare and digital health that are worth calling out to our audience?
Yeah, not policies, but when you think of like DTC or biopharma, advertising or biopharma, I think there's a couple things to think about here. And one is it may not be an emergency because of the patent protection. And so their view is, hey, maybe we can still control the market despite of favored nation pricing. You think of something like an EpiPen where there's no generic, so you probably have room to move price down, even if there is that pressure. The most interesting stuff I've seen is more on that advertising front. We're seeing some softness in terms of fourth quarter, back half of the year. Stan over at Wells Fargo did a great KOL call that suggested some of those macro growth rates have come down in the back half of the year. I know Elizabeth over at Evercore is doing a KOL call on June 23rd on biopharma advertising. So, that the pin action there is kind of Doximity. I don't know how many other, innovative companies are built on bio advertising, but I think if you're someone serving that space, it's probably more concerning and more important to track what's going on in the CRO space and where you're seeing some, concerns. I'm not familiar with all of the drivers of the disruption, but there's certainly some softness across the board in that space. And I think that would tend to be negative for people serving clinical trials.
And for our audience, if you have any questions about Trump policies that have been announced recently, you'd like us to comment on, or also any business or trade journal stories that you'd like us to comment on, feel free to throw them in the chat. And so let's see. Moving on to business and trade journal stories, I think we're still seeing fewer fundraising deals announced, which is unfortunate. We want to see lots of fundraising of young digital health companies. And that seems to be in part from the Trump pause. So the Trump pause is that young companies still need to raise money at the same pace as before, but VCs feel that there's uncertainty, and so they pull back and they say, let's just wait 30 days or 60 days or 90 days, and then we'll know more at the end of that, and we'll know whether we need to head for safety or whether we can invest in some companies but not other companies based on the new information or whatever. So that's what I'm seeing from the trade journal news about fundraisers. But Steve, did you have any thoughts on that, or did you have any stories that you saw in the trade journals that you wanted to call attention up to our audience?
I think from this topic, and it's a couple weeks old, but Hallie Tecco, put an article out on LinkedIn where she, I call her kind of the OG of digital healthcare. Like, she started Rock Health, like as a person I've followed since 2013 in this space, and she kind of got out of the angel investing game. And I think when someone of that stature that everyone knows is kind of an expert or someone who's seen as a representative of the industry says, hey, I can't do angel anymore because we get diluted to zero, I think that suggests there's some issue in the environment. And And I think to your earlier point, Steve, it's a flight to quality or a flight to less risk that you're seeing these bigger deals at maybe more well-known names that have been around because maybe they feel safer and feel that there's maybe less dilution risk. But it seems like the appetite is tough if you're someone, starting out like and trying to raise that seed round or that first round of funding, because again, it's the risk is just so high these days. And the other angle I'll give you is like, from a nonprofit perspective, like this is really hitting the nonprofit world. Like I sit on a board of a group called Chicago Scholars here in Chicago. I was a scholar. They give a scholarship and award to one student in every high school in the city of Chicago. So it's meant to help low income and minority students get to college. And the planning has been, hey, we're not going to get funding from the government. Like, and it's really hard to get funding from a nonprofit. And so if you extrapolate that thinking, then it's got to be even harder for people in the innovation market to be raising right now if they're cash strapped.
Interesting, thank you. And so we have a question from Kimberly, which is, would love to hear any other thoughts you all have on the CRO space and the impact on it as a result of policy, regulations, and economy. So when I think of CRO, I think of clinical stage biotechs and big pharma spending money on CROs to do research for them on drugs. And there's a couple of things going on right now. The first is that biotech has been in a real downturn for a while. And so companies are just having trouble getting money to then move projects across through clinical trials, through early stage trials, and then clinical trials. And so that means that there's not as much well-funded projects in the pipeline that are going to be chosen by well-funded biotech and well-funded pharma to send to CROs for clinical research studies. So that's one problem. The next is earlier in the pipeline, we've seen with RFK in HHS, what we're seeing right now is there was sort of an old guard of funding basic research. The US is the biggest funder of basic biological research in the whole world, the US government. There's sort of an agreement that the federal government should fund basic research, and then private entities should fund the commercialization of that research and reap the benefit of that commercialization. And so there's an old guard in the government. Anthony Fauci was one of them, and they had a system that worked, and that where they were often giving money year after year to the same or similar projects with the same or similar researchers. And this is mostly a good thing because of stability, but it did have some downsides. Like they did a lot of funding of Alzheimer's research where the investigators turned out to be frauds, and they didn't discover that early. So that's one problem. And also, if you're a young brilliant researcher, you may have to work for somebody else for 30 years before you finally get your own grants to come in, because the old system was kind of ossified. And so it had its pros, it had its cons, did a lot of good, spent a lot of money, did a lot of good. But with Trump and RFK, you're seeing a real shakeup for the first time in decades where they are defunding some areas, they are changing the people they're funding, they're changing the priorities, they're funding new areas. And so what does this mean? Well, it turns out that with basic research, you need like 5+ years of basic research on certain topics to get far enough along, or longer than 5 years, to have stuff that's ready to hand to the commercialization people. And so this kind of dislocation interruption is bad news for the pharma product supply chain, because there's going to be less product coming from established sources to them. And then the new stuff is too early, will take years to get to be ready to be commercialized, and we don't know if it's going to be productive or not. And so this is a shakeup. Maybe ossified systems need shakeups from time to time. It's the biggest one we've seen in a long time, but it means there's going to be a big interruption. So there's a lot of so in the CRO world, it means that the regular supply of high potential products that then get funding to do research studies on is going to be interrupted.
I love this topic, like, because you think about it, like, you have some patent cliffs again. Humira was relatively recent patent cliff, others, and it harkens back to the cycle. The CROs had a down cycle coming out of the Great Recession. And at that time, you had some really epic, developments. You had, Pharmacet, Pharmacyclics, Intermune, Dendreon even got approved. And I felt like you had this, from that '09 to 12, you kept getting these like new biotechs that would pop and work, and then it moved to cell therapy. Analinelam kind of like hit the bottom in 12, and now it's a superstar company. And I feel like we've not been able to repeat that cycle here in the early mid 2020s. And And it goes back to what you said at the top, where if you look at the funding, like there were some good articles a few years ago in the Financial Times about this, where if you look at on average, I think biotech would do, call it closer to $8 or $9 billion a year in like IPOs or whatever, what have you. And in COVID 20 and 21, it was like 25 and 30 each of those years. So you pulled forward like 5 years worth of new companies coming to market. And then the other problem is it's almost like for biotech and for healthcare IT and the SPAC craze, you had this something analogous to the reverse mergers, the Chinese reverse mergers that happened around the Great Recession, where companies were like, okay, we'll buy, tertiary assets from some company's portfolio. Like I think it was Abiona, Tasha like bought like these tertiary assets from Abiona to IPO, and then the IPO at like an obscene, a huge valuation, and then they don't, maybe you don't get those assets developed over time. And I may be getting companies' names wrong, so I'm sorry if I've disparaged someone. I'm trying to remember from following this a while ago, but it's just suffice it to say that you pulled a lot of funding forward and you've destroyed a lot of that value, and it's been really difficult to get investors to come back to the market. And on top of it, like you look at Summit, like Summit is the big name. Robert Duggan, again, like he had Pharmacyclics. He found the interesting asset. He's working with the Chinese company, and that stock has been decimated over the last couple of weeks because, again, FDA doesn't like ex-US data. If it's not US, if it's not UK or Europe, it's hard to get approval, and it's hard to, extrapolate those phase 2 into phase 3 when you're looking at your phase 2 ex-US. I think all of that is a long way of saying that it's hard to see, you're seeing some buyouts, which I think is positive, but you're not really seeing the development that's like, oh my gosh, there's some awesome drugs coming to get the CRO space excited again.
So, and I'm going to skip some parts of our show plan just for time reasons, but the next section is reports that have come out that matter to us in the last couple of weeks. And for our audience, feel free to throw any questions about reports. And so I was delighted to see that Mary Meeker, the former internet analyst from Morgan Stanley, now a VC in Silicon Valley, has come out with her new Internet Trends report. This used to be a famous, awaited thing, and but she changed the name from her, and she hasn't published one in 6 years. But she changed the name now, and now she's calling it the Mary Meeker AI Trends report. So that's interesting. It's all about AI, and I took away I think it was 380 slides, which is absurd, and it tells you the kinds of people who go on to become sell-side equity research analysts in life, and because there's people who are reading every slide, and enjoying it. So I think two of the things I took away from the report, one was just that the adoption of ChatGPT, if you treat it like it's a consumer product, is the fastest adoption to 100 million ever of any major product. And so, and it's significantly faster than the competition. And so that's really interesting. You have millions or billions of people who have a behavior pattern that they go to Google search for answers. And then it turns out that it's just as easy to go to ChatGPT, and they get a very different experience from ChatGPT than from Google search. And Google's trying to play catch up now with Gemini AI, but they get often a better answer with less ads if they go to ChatGPT. And so just incredible growth that continues. And all ChatGPT has got to do is just keep this up, and they'll grow into their valuation on a consumer use basis of search, of search and answer alone. So very interesting that this has been sustained. A lot of us thought this would be a big deal, 2 years ago, and this continues to be a big deal as measured by growth. And then the next was Mary Meeker. I think this was meant to be humorous. She pointed out that among big tech, so big tech is investing enormously in generative AI for the B2C market and the B2B market. And so big tech, so capital investments is way up for big tech. Revenue is up for big tech, and margins are down for big tech. So that she says that this means that the consumer is a big winner here because they get delighted by these fabulous AI products. But whether this will ever pay off in terms of a future of better margins for big tech, for Microsoft, Google, etc., is an open question. So I think she found that every big tech company that has a major AI contender has seen its margins go down, except for Facebook, Facebook, which has kept its margins the same. So anyway, that's AI.
Yeah.
Any reaction and any reports that you've seen that have come out that you want to call attention of our audience to?
Yeah, I love it that, it's interesting that she shifted from written product to slides, number one. Number two, I actually have original copies of her original internet reports in storage that I bought because when I embarked as a full sell side analyst, I wanted to be the Mary Meeker of digital healthcare and like, put out like these innovative reports and say, hey, this is where we're going. The problem was it fell in a forest of all these trees that no one wanted. Everyone wanted disruption, but no one wanted to dislodge the incumbents. Like if you any disruption to the valuation of like a Cerner or an incumbent was a problem for the innovative companies. And I think what's interesting is I did a digital healthcare event here in Chicago, I guess a week ago, and what came out of that was one of the top use cases of Chat GPT is for companionship. Like I, in a million years, would never have thought to go to Chat GPT and treat it as a companion for myself. And like one of the problems is there are people who are using it for behavioral therapy. Like instead of going to BetterHelp or getting their therapist, they go to Chat GPT. And to me, it's like, it's insane. Like it was interesting. They did a raise your hand poll of like, have you used Chat GPT? Have you used it at a higher level? And then the last question was, would you allow your child or a nephew or a grandson to use Chat GPT as a therapist? And there were actually a couple of people who said yes. Like I was like, no way. Like I don't think it's fully baked yet, and who knows what is being put into the system. And that was the thing. It was some insane number, like 60 or 70% in some study. It was like, or in that part of digital healthcare was like, hey, Chat GPT is a companion, and it's like, wow, that's really mind blowing. And I think the other stat I saw is it's bigger than Wikipedia all of a sudden, or one of those types. It's like all of a sudden, the inflection point is here. So it's like, it's interesting, and you're right. I think we're still a little far away from like visibility into the monetization of AI or Chat GPT. And I think like if you're in healthcare, I think if you can use it to help clinical documentation, think ambient listening, can you use it to better adjudicate revenue cycle? And can you use it to better adjudicate and automate credentialing, licensing, privileging from a physician or provider perspective? You're going to make a lot of money. That's where you're going to be successful.
So what you're saying about using ChatGPT for companionships, I can totally see that playing a role in the future in mental health, behavioral health products in digital health. And this reminds me of the movie Her, which has Joaquin Phoenix, where the operating system of his phone is updated and it becomes a woman who he begins to have an emotional, quasi-sexual relationship with. And then a number of things happen, like he through listening to through language, he understands that maybe she's having this kind of relationship with other people on whose phones she's on the operating system of. And then it turns out that actually she's having this kind of relationship with millions of men out there. And then finally, she just, even though she's the operating system on his phone, she just vanishes because she figures out that other AIs are more interesting to hang out with than humans. And so she just abandons humans and hangs out and talks with the other AI and has a relationship with the other AIs instead. So that's
Siri was my number one. I can't believe she's cheating on me. Siri, why'd you cheat on me?
Yeah. So, well, okay. So now moving on to one of my favorite parts of the show, which is what is a consumer technology that's affordable that you could use that has improved your life in some way? And I'm actually going to throw out an interesting concept I put into use, which is that there's a growing amount of sort of serious power banks out there. We're used to thinking of a power bank as something the size of our phone that can recharge our phone once. And instead, there's bigger ones now. There's ones that are the size of like, small bottle of Coca-Cola or something, and that could recharge your laptop and your phone 2 times or that sort of thing. And so I actually had a thought that I would put one of these in my car. And so yeah, I have one in my car. It charges when I run my car, and then it sits there and when I don't run my car. But then I linked my car charger not to my car, but my phone charger in my car, not to the car's outlet, but to the battery. And so now my phone will charge 24/7 in the car, and the charging doesn't stop when I stop my car. It's also faster to come out of the battery. So instead of putting my phone and charging it with my car's charger at a slow rate, I put it on the battery, and the battery shoving juice into my phone as faster, for example. So that's one thing. And then also I have a aftermarket dash cam on my car. And what the nature of dash cams is that they run while your car's running off of your car's electrical system. And if you have an accident, you've got that saved, and you can even press a button on it and have it call attention to a spot in its 12 hours of footage or whatever, so that and save that spot. So that, where somebody dings your car while you're driving or something like that, and you save that, the video of that or whatever. But now it was not intended by the product, but I can plug the dash cam into the battery, and now it runs all the time. So you turn your car off, dash cam's still running. And people who live in RV life have two batteries: the battery that runs the car, and you can't drain off of that battery because you don't want to wake up in the morning and turn your key and have your car not start and have to jump your car somehow. Then they have a second battery, and they run the coffee maker off of the second battery, and they run other things off, and they run the lights off the second battery. And so I got the Anker 737, which is the best-selling power bank, 24,000 milliamp hours, $100 on sale on Amazon. So I got this, and it's giving me a second battery for my car at the scale of a commuter car, not at the scale of an RV or whatever. So I think we're going to see more of this. I think this means my car is now a source of electrical power, even when it's off, to charge things, to run my laptop, to whatever. I don't have to be running the car for that. So anyway, so Steve, do you have any thoughts on a technology that's improved your life?
I think you're holding out on us. I think you're hiding like a fleet of Priuses that are like mining Bitcoin that you're not telling us about the audience. And I think it's interesting. I would say I'm going to give you two here. One is just, you think of cameras on phones and Zoom and your cell phone, because I can do videos, put them on YouTube. We're talking here through that technology, and even with telemedicine, like we're able to provide a neurologist in San Francisco to someone in the middle of nowhere, Maine, who's presenting emergently with a stroke, and getting them triaged and keeping them in that regional hospital or critical hospital in the middle of nowhere. And the other one, from a digital health angle, is the fountain of youth for someone who wants their youth back is a Peloton and Noom. But if you religiously do those workouts on Peloton and you combine the nutrition of Noom, you've got a changed outlook on life. And I've not used it, but I have witnessed its strength of success. And that's where I used to think like Teladoc should have bought Peloton and Noom and just use that to kind of layer in monetization on that PMPM of direct to consumer telemedicine.
That's great. Thank you. Yeah. And so for our audience, I think what's interesting about reacting to what you said is that, so I knew a guy who got trained in professional video production, and for the rest of his life, he could never make a video that had compromises on video production quality. So he wanted to make videos, but it was a huge deal. He needed other people, he needed lighting, he needed a professional grade camera, and he couldn't bear to film something. This is meanwhile during the YouTube revolution, when there's people who are brushing their teeth in the morning and while talking on video, and pausing to spit in their sink, or there's a minimal video production value on YouTube. And I think that the lesson there is figure out how to have something to say, something important to say, and then you can get away with any level of video production values. So I didn't do this, but I had a goal of doing 5 minutes on digital health deals. And so I would treat myself to a new coffee shop every morning in Boston. And then standing in the line for coffee, I would recite from memory my take on 5 deals in digital health from the prior day or something like that. And meanwhile, you got the cappuccino machine making an enormous roar in the background, and people bumping into me and being rude because this is Boston. And all that would be captured. None of that matters. It would add to the flavor of it. So anyway, but I think part of the lesson of that is that you can get away with minimal video production value. You just have to, you don't need to have a studio like the local news team in order to speak, but you have to have something to say.
Davey Day Trader, Dave Portnoy, I mean, he proved that with, pizza reviews and stock trading of a guy who was not a stock trader. Like, my joke was, who needs an investor relations pro for your company when you got Dave Portnoy Twitter?
So I live in Dave Portnoy's old neighborhood in Boston, and he went to an old pizza joint and on the street reviewed their pizza, a couple-minute review of a pizza. And then the staff was wondering what's going on, and the owner happened to be on premises, and the owner turned out to be a belligerent guy. And so the owner came out and got into a massive smackdown argument with Dave Portnoy. And then Portnoy ran the video of him being interrupted by the owner and having a verbal smackdown with the owner, and that went viral. And that was my local pizza shop right there. And Portnoy's review was negative because the pizza was too parmy, was the review. Had that been it, then the review would have been seen by 1,000 people. But if the owner steps out and tells him to get off the property and has a shout fest with him, then that goes viral, gets 2 million views, whatever.
So I guess what I should do is go to all the different hospitals and do a video of their Epic instance and see if I get some doctors to come out and throw a tantrum like I can't stand this EHR, and see if it's Epic or Meditech or CPSI or whoever it is.
So for just jumping on to the next, so upcoming conferences. So interestingly, New York is lacking a great digital health conference, except that Tech Week, which is sponsored by Andreessen Horowitz, is becoming the big software and digital health conference of New York. And Tech Week is this week, started 2 days ago. It's June 2nd to 6th. There's some ridiculous number, like 100 parties a night in Tech Week, and most of that is B2C and B2B software. But a lot of it, a significant amount, is healthcare. So healthcare is finally getting into New York City Week. Digital health is getting into New York City Week, and it's the general Tech Week sponsored by Andreessen Horowitz. They do it in other cities as well, but in New York, it's got a strong digital health flair. So if you're in New York, try to go to some of that this week. And then, interestingly, coming up, there's the Aging Code Summit. I know these people. I like these people. And this is a Boston longevity biotech summit with an emphasis on AI for genetic disease. So there's a software angle to this, reading the AI code, writing better genetic code to prevent and disease. And so they gave me a promo code, and you can use the promo code Aging Code for the Aging Code Summit for a 30% discount on their ticket price. And then Bio is coming to Boston very soon, June 16th to 19th. So Bio is overwhelmingly about young biotech companies and big integrated pharma companies and new molecules. That's what Bio is about. But like 3% of Bio is about software, enterprise software selling into the big budgets of pharma, also software for new drug discovery. That's a small part of it, but actually the big theme this year is going to be AI for drug discovery for all of Bio. So this little part, the software in Bio, is the most exciting part of the conference this year. And so I recommend for digital health people who sell into pharma, go to Bio in Boston, especially if you're on the East Coast, and then do a lot of homework to figure out, like you see thousands of professionals there, but which are the ones that are software people is the question. So if there's a pharma corporate venture fund, which of the partners there have done software deals? There are some who, most of them do mostly molecule deals, but who are the ones who've done software deals? And so finding the buyers of software who go to Bio and finding the partners, finding the investors, they're there. This is a conference that investors attend. Digital health investors attend this. Pharma tech investors attend this. But you have to find them among the sea of molecule people who are there. So those are some upcoming conferences. Steve, do you have any conferences you want to call our audience's attention to?
Yeah, the truest digital healthcare conference is in June in New York City. I'll be there, and it's a bunch of other small digital health disruptors. So Access Telcare, I'll be a part of that, and several other public privates. It's a 2-day conference, so if you're inclined from a VC or investor perspective, you may want to hit that one up.
Very interesting, and I'm not very familiar with that, but I will look into that now that you've mentioned it. And then personal notices. So I have a digital health innovation night in Boston coming up June 12th with Springtide Ventures. They're an AI healthcare fund in Boston, and their investor Claire Smith. And then I'm doing a reception in advance of Bio in Boston on Sunday, June 15th. That's for the national audience that flies into Bio and is sitting around talking to their ChatGPT on their phone because they're lonely. So on June 15th, you can come out instead of getting seduced by her on your phone. You can come to my Bio reception on Sunday, June 15th in the evening, and and Steve, any personal notices for you?
Yeah, these are great events to go to, and the one I was going to throw out was the truest thing again, but look out for Health to Tech. I think that's the one I went to here a week or two ago, and it was a good event. They have them all over the country, and I see it on LinkedIn all the time, popping through. While we're talking, I'll try to pull up the name of the people who run it, but It was a really good event here in Chicago, and it got a lot of traction when they posted about it afterwards on LinkedIn. So I think it's worth it for people to at least check it out.
That's great. Well, so now we'll move on to the second half of our show, which is the today's topic: why not more successful exits in digital health? So I'm going to date the founding of the modern sector of digital health to 2009. Two things happened in 2009. The first was the meaningful use subsidy. For a $40 billion government subsidies dropped on the heads of pharma hospital CIOs. I'm sorry, dropped on the heads of hospital CIOs to encourage them to buy electronic medical records and make meaningful use of them. And a significant portion of that money went into the pockets of Judy Faulkner at Epic. But that was a starting gun for entrepreneurs all over America who may not have been in healthcare to jump into software in healthcare, to remake healthcare, to do well and do good at the same time. Also, it was the end of the global financial crisis and the start of the Fed's ZIRP policy. And the ZIRP policy meant that investors valued over all other things growth. And there's only two growth sectors on earth: healthcare and technology. And digital health is the center of both of those growth sectors. And so investors all over the world wanted to increase their allocation to digital health in the US. And so you saw massive entry of venture funds and venture partners and talent and dollars and LPs and new funds and new investments in digital health companies and startups, and just massive entry into digital health after those two things happened in 2009. And I remember those days, Steve. I think we thought it was because we were geniuses, but it was actually because the Fed had a zero interest rate policy, which when you're in a bubble, you never know you're in a bubble. Everything just seems like it makes sense relative to everything else inside the bubble. And so then, the Fed a couple of years ago raised rates rapidly, and the ZIRP environment fell apart, and we're living in the consequences of that. But why not more successful exits? So I wanted to sort of say, you'd think there would be successful exits because healthcare is a huge category and software is eating healthcare. And so those software companies should turn out to have great exits. And healthcare is growing faster than the regular economy. And there's also a huge gap in skilled labor in healthcare. There's not enough skilled labor today. There'll be even greater gap in the future in America and the whole world. And so that means that the incumbent healthcare players are going to have to buy software automation solutions to fill that gap between the demand for skilled healthcare labor on the one hand that can't be met. So what fills that gap is software automation. So there ought to be great exits, but there haven't been so many. And so I want to put forward two answers to why. There's two general answers. So one is that structurally, digital health software companies, it costs more to build a product, so you invest more. And then it scales more slowly because the buyers are picky and hard to sell to, more so than B2B buyers. And so that just structurally, it means that these companies are not going to look like attractive exits when they hit 50 million in sales or 100 million in sales. They took a bigger investment to get to that point, and they are growing more slowly. And so that's one reason why there haven't been so many good exits. And another one, I think, is a very deep answer to the question, but it is that digital health companies have not figured out how to add a lot of value compared to the other stakeholders in the industry. And this is partly because of regulatory reasons. So, you can view this as that industries have a lot of revenue in them, and they get hit by technology shocks. So some of those shocks were the web, e-commerce, mobile, SaaS. A new shock is AI. AI is a big shock. And then these enable tech companies to dominate. So mobile enabled Uber to dominate the taxi industry. E-commerce enabled Amazon to dominate retail, have fabulous exits and create enormous value. The web enabled Facebook to dominate media. But this doesn't seem to happen in healthcare. You don't see tech companies taking over hospitals in all the big cities of America. You don't see new national brands in healthcare emerging. People think Apple's going to be the new national brand in healthcare. Could be. But you don't see Apples in health. You don't see healthcare creating its own Apples. And so part of this is because digital health companies in general, they offer software. They don't offer care. And so you can't practice care unless you have doctors with licenses in America. And so doctors have this regulatory advantage where they can always claim the lion's share of revenue, and they don't need software as much because software can't practice medicine, but doctors can. Because software is so regulated, because the healthcare industry is so regulated, software companies have not been able to take advantage of this shock of web and mobile and SaaS and AI yet to take over an industry the way that Uber took over taxi driving, riding the wave of mobile. And they haven't been able to displace incumbents. Young digital health software companies haven't been able to displace incumbents in the industry in general. And those incumbents look oligopolistic, so there's a certain number of giant health plans. Haven't been a lot of new giant health plans in the last 50 years. A certain number of major hospital chains. Haven't been a lot of new hospital chains in the last 50 years. So those are some macro reasons why we have not seen a lot of good exits in digital health. There's also plenty of mistakes and buffoonery we could point to in individual cases. So, and then the intriguing question might be that two trends I see in venture funding today in digital health. One is tech-enabled services. Now, those are not software companies. Those are services companies. Often they're offering care, competing directly with providers. So I call this, is the CEO a white coat? That's old services in healthcare, or is the CEO a black turtleneck? That's new tech-enabled services in healthcare. And it's the battle of the white coats versus the black turtlenecks. And then there's Gen AI. Was Gen AI going to be different somehow? Is Gen AI going to be a technology shock that opens up healthcare and allows new tech digital health companies to figure out how to really add value and displace incumbents? So that's an intriguing question. So with that, I thought I would turn it over to you for a reaction to that. And then I know that you want to talk about some trends, some specific companies as well. So we'd love to
Yeah,
get your
well,
reaction to that.
we'll get it all worked in, I think, to the answer. I think, what's interesting is when you think about the tech companies that have been successful, there's two secular trends that we used to talk about when I was on the sell side that we loved. It was network effects businesses, think OpenTable, because it's part of the OpenTable IPO, HomeAway, even Fitbit. These all were network effects businesses. And then the second piece was Netflix is one too, like digitizing the undigitized. And that's essentially what you have those secular trends here in healthcare. But the problem is that it's nearly impossible to scale revenue and margin in healthcare from a tech perspective. And the reason is when you think of a SaaS company or someone who's selling software, you seemingly have an unlimited market to sell to. You can go to a number of countries, you can go to a number of cities, number of industries, and you're constantly growing. You come up with a new solution or a new piece that you bolt on to whatever that platform is, and you just keep growing. And that doesn't happen in healthcare. Like if you're someone like us at Access Healthcare doing acute care telemedicine, you're selling to a hospital. You've got 6,000 hospitals. You have a finite number of people that you can sell to. And that's what makes it very difficult. And then the second piece is in terms of trying to scale margin. And when you think of a telemedicine business in some of these businesses, traditionally revenue and gross margin are sort of a directly related ratio that as you grow more revenue, your gross margin should expand. And some of these businesses, you have to look at the revenue line as one function and the gross margin line is a completely separate function because yes, you're adding clients and adding volume to the system, but the gross margin part, you have to manage resources and manage the utilization of a network. And so it makes it a much more complex business. And I think the irony when you do an analysis of a lot of the public digital healthcare companies, I did about a universe of about 40, and I think only 30% of them are net income positive. And as you get below the high end of mega cap, almost none of them are net income positive. And this is the struggle that because these businesses are not just technology and there is a very high personal component, it's hard to get to that 60, 70% SaaS margin. A lot of these businesses truly probably are 30 to 50% margin businesses. And I think one of the things that digital healthcare has to do is say, we may not be a rule of 40 or, really the sexy number is rule of 50 industry. You have to do the analysis. Maybe it's rule of 20. And if you're doing better than that, maybe you should get a premium valuation. And the other joke I think here is doing that analysis is, we kind of compared our business to some others. Like you look at a Talkspace or a Teladoc, say someone who is direct to consumer, and I'll get to hims and hers in a second. But like the joke is the best businesses get paid for not delivering care. like a lot of their revenue and their growth is because they have a subscription component, and that, either the consumer is paying a subscription or the payer is having a subscription through an employer sponsored model. And then the care piece is really small. Like where we're at, the majority of our revenue is based on, hey, a doctor saw a person having a stroke or a heart attack or a behavioral health issue on Zoom, and we treated that patient, and there was a positive outcome. And the closest we have to sort of that subscription model is revenue cycle management. It's not something we had before when we were public, but we have it now, and that's the key. I think when in the other part to kind of to wrap this up, to kind of think through this is a lot of tech people come from Apple or Google or Amazon and say, hey, you know, healthcare simply sucks. I'm going to fix it. But the problem is you need to have a doctor or a clinician in the seat, either the CEO, you need to have a white coat who wears a black turtleneck running the business. And that's what I think of as Chris Gallagher, our CEO. What's interesting about him is, he has probably the longest tenure of being a CEO in telemedicine outside of Ray and Ido Schoenborg, now that Jason's no longer at Teladoc, and no one knows him and no one knows this business. And it's been around 10 years. And we've done 7 million acute care consults since inception, over 1 million consults just in the last year alone. And, it's hard. And what I want to get to about the black turtleneck wearing the white coat is, we're very focused on technology, technological innovation. But at the same time, when you go to a sale, having someone like Chris in that seat, he can go into the hospital network and the person will say, okay, telemedicine is driving up costs because we're doing too much radiology. And because he is a doctor and the other executives on staff are doctors, they understand, okay, well, if you then send the patient to outside to do the x-ray or whatever it is, now it's a revenue driver. And a tech person who works at Google or Amazon is not going to have the sophistication to on the fly adjust to whatever, seemingly esoteric complaint. Esoteric is a strong word, probably not the right word, but, seemingly a big deal to that client, but in reality, it's something that can be solved very quickly. And you get that done by having that clinical know-how. And I think, and that's the key. That's what I always liked about this business, because Access is kind of the combination of SOC Telemed and Access Physicians. And the beauty of Access Physicians, the business that Chris built over time, is it had multiple layers of revenue. And I think this is what innovators need to be thinking about is, yes, we were delivering revenue for delivering a consult, but there's also a rounding piece. So that's boots on the ground in persons. Then there was a little bit of revenue cycle. And then there's the technology cart. And so you have to have this holistic approach to developing a solution to the market. And then, okay, great, this is a great solution. Everybody needs it. No one's going to tell me, hey, I don't want to have a Zoom call doctor in Williston, North Dakota, where there's no neurologist. But the point is, there's two key issues still. People are people. Like if you're a clinician in that hospital, you're threatened by technology and you may not like this system. Oh, I don't know how to push the button on the cart. The battery doesn't work, or I can't push it to where I need it to. And these are all like, what I'll call BS is not the right word, but like very, and, not legitimate or very strong friction points. These are friction points that should be solved or that you can remove very quickly. It's not like the care doesn't work. I can't actually care for the patient over Zoom, which you can. And that's where for me, like in acute care telemedicine, like, yes, maybe the revenue or growth isn't there, but like there's real value here in what we're doing and delivering to patients because you're seeing true outcomes. And the other metric I'll give you is in SaaS, it's all about what's your long-term value of the customer versus the customer acquisition cost. And if you're selling into hospitals, it's all about what is the case mix index relative to your average daily census. And what that means is that can your technological solution allow the hospital to keep the higher acuity, more complex patients versus transferring them through a helicopter or ambulance? And then secondly, by doing that, keeping them and keeping more patients actually in the hospital where you're not getting the leakage, you're not getting the transfers. And that's how you really get someone excited and show value. Okay, we got to go buy this service. We got to go buy that service. If you can't do that, you have a problem. And then one other thing I'll give you here is, when we were on the sell side, Athena Health, like the two companies I loved were Jonathan Bush, Athena Health, Arik and Glenn at Medidata Solutions. And what was the common denominator of those systems? Single instance, multi-tenant software. And that's what Azure is. That's what AWS is. And the problem is Healthcare is built on multi-instance, single-tenant architecture, which is Epic. And the issue there is it's not necessarily a bad thing. It works, but the problem is it is not set up to deliver care efficiently across a broad spectrum. And so, one of the struggles you have from acute care telemedicine is Dr. Steve, is on call today, and I might be seeing patients across 10 different hospitals in 10 different states, and they might be, 3 on Epic, 3 on Meditech, 1 on Cerner, who knows? And I got to log in, log out, and I got to figure out how do I get the clinical documentation correct. And let's say all 10 were Epic. I may not even know how to do the clinical documentation across all 10 of those EMRs. And then Dr. Steve is like, screw this. I don't want to do this anymore. This is crazy. It's too hard to log in and out and like document what's going on. And that's where one of the biggest problems for us is just that the basic architecture. While it's been a great business for certain companies, it's not necessarily the right architecture for us to scale in terms of the solutions and services to drive to a great exit or drive to a more efficient healthcare industry. And until we figure out how to do that, and that's the other piece. It's like it's the clinical documentation. If you don't get clinical documentation correct, meaning you can't code and you can't do RCM correctly, your technological solution has no value to anyone, which is a paradox because it should be based on, oh, I'm improving the patient's life. But if you improve the patient's life and you're not getting paid for it, then nobody really cares at the end of the day. And I'll stop here for a second with the idea of if you are an innovator listening to this, the one thing I would tell you to do is watch Eric Bricker A Healthcare to Z videos now until you're done, because I think that is the best tutorial you can get to figure out how to really navigate this system if you're coming from like tech and you want to make sure that you get paid and understand how all of this works.
Really interesting. So I will check out Eric Bricker videos. What are they?
Yeah, he's a physician, and he does like, they're anywhere from 10 minutes, sometimes 15, 20, 30 minutes, but like he'll do the entire discussion of how does revenue cycle management work from the most basic concept to the end. And it's accessible for people who don't know what's going on to the person who is the most knowledgeable. And it's just soup to nuts. Anything you ever wanted to know about, selling to care in a hospital setting, you start with him because they're free videos on YouTube, and you'll become smarter than you ever wanted to be on the space.
Yeah, I want to pick up on a couple things that you mentioned there. One is that many digital health companies that are in the employer health tech space, so they sell solutions around maybe it's diabetes, hypertension, musculoskeletal to employers. Many of them, they love to have the employers pay on a per member per month basis and get the money in. And they actually would rather that you didn't use their product. This is like
Exactly.
the dark secret of your gym manager. He's standing there at the desk smiling at you when you walk in, but he really wishes you wouldn't use your gym. He wants you to pay your monthly fee and then not come to the gym. And then things will be great. Then he can double gym membership and have underutilization and no wait times at equipment or whatever. So but that's surprisingly true in digital health. People who offer a service and get paid to offer a service and then they don't have to deliver the healthcare and they don't want to deliver the healthcare. So that exists. And then also you mentioned how in fee for service in healthcare, you have skilled professionals doing labor and getting paid a fixed amount that comes in, which is their fee for the service they're offering of their skilled labor to address a healthcare problem. So that exists. And then a tech company comes along and says, I can put some of that skill and intelligence in my tech product, so buy my tech product. And then the skilled professionals are very threatened by this, actually, and they're sitting there scratching their head and they're saying, wait a minute, you mean so we get the same money comes in the door, and then this chunk of it goes out to you, the tech vendor, and then what's left is split among us, the skilled labor. No, we do not want your tech products. We want to provide our skilled labor. And then you say, yeah, but you have better health outcomes with my tech products. But the skilled labor is like, no, I can see where this is going, and no, I do not want your tech product. And so they're disincentivized from providing better care with tech products because of the fee for service nature. They want to bill people out at their highest billing rate, but they don't want to have tech, they don't want to have to pay cash out the door for tech. And then also, I love your remark about that winning tech companies are single instance multi-tenant, and then the central healthcare tech company of Epic is multi-instance single tenant, which is a disaster. That's been a rolling disaster for like 25 years. A hospital chain that was running Allscripts, which is now Veradigm, and in one case it's on-premises software, in the next case it's regional SaaS, in a third case it's true cloud SaaS with different versions, paying different prices for them, and just years and years go by and it never gets reconciled and rationalized. Well, so we have a few more minutes left, but I think our audience would love to hear. So you have takes on companies like Livongo, like Teladoc and 23andMe and others. And I know people thought that Teladoc was going to be a real bellwether in industry. And at the time of the merger with Livongo, people were even saying this is the new care delivery model. The new care delivery models, we're not going to be walking into bricks and mortar hospitals. We're going to be going to Teladoc. You know, and get and have a to Z care from Teladoc instead for the primary way that we're seen, and then only later default back to local bricks and mortar buildings or whatever. And that didn't come to pass, and the stock price of Teladoc's been a real disappointment. There's been a shakeup at Teladoc. So the bellwether turns out to have been a negative bellwether, unfortunately, for the sector of Teladoc's story. But maybe you could tell our audience the story of some of these companies that didn't have such great exits that you had been thinking about?
Yeah, I think there's a few that go together, and then 23 and Me is a little separate, but a interesting story for the group. And the ones that are kind of similar are like a Tabula Rasa Healthcare. That was more circa 2013, 2015 timeframe. Go, Teladoc, even GoodRx and some of these others have had it, but for different reasons. But the core piece is it goes back to technology. You think of these sexy names we said earlier in tech, and every business always has a hockey stick growth curve. But at some point, that growth curve ends. In technology, typically they're able to figure out what's the next investment. Do I purchase a company? Do I come up with a new piece of software? Do I come up with a new solution? And they're able to reignite that growth or that secular growth. That's why Facebook is paid. It has such a premium. That's why Netflix has such a premium. But when you look at Teladoc, it's like, okay, we grew, our growth was great in terms of per member, but then we were saturated and we thought, okay, Livongo is going to get us there. But the problem is when they bought Livongo, you had already seen that huge hockey stick of growth in users. And the way you had to grow was through, incremental price changes. Once you've throttled, you have two levers here in a business. It's either, user growth, utilization growth, or it's your pricing growth. And in healthcare, again, like that utilization lever is very limited or very, once it's saturated, you're never going to reignite it. And you're not always going to get to the full 340. And so then you have to start to get creative. And like I've always thought, when you think of like Teladoc or what it is, like how do I take, okay, my initial base per member per month is telemedicine. And then what are the next things I can layer onto it? And the best example I would give you is there's a Chinese internet company that I worked on the IPO called Qihu 360. And what they did is the founder had sold his business to Yahoo. They ran it into the ground. He's like, hey, we are going to destroy Yahoo China. So he created Qihu 360. He gave away security software to 500 million users for free. So he built a 500 million user base. And then he came up with all these other solutions that were 50 cents or $1. And over time, they monetized from 0 to 50 to $1 to $2, $5, $10. And that's where I think the struggle has been in the transition for some of these models is they don't get creative in thinking about, oh, is this really going to be incremental to that PMPM? Like, is it similar? How similar is the solution? Like when you think of like adding Peloton on, Peloton is a very different solution to Teladoc. You're adding on preventative care and a lot of the workout type of content. Then Noom, it's nutrition. Again, it's completely different from what Teladoc does. That's how you kind of get creative and reignite that growth. And then 23andMe, I view 23andMe as more of a cautionary tale for a lot of founders in this space if they're watching this call. And I think what you're seeing there is what I call the politics of billionaires at the highest level. Like a lot of people are not at that board level and don't get to see the inside workings of that board level. I've lived this experience of what went on, and you've seen two failed takeouts, goes into bankruptcy, and then all of a sudden it's getting bought by Regeneron, and now the founder is fighting it again. The rule of thumb here is you never want to take a zero. And what people don't realize is that at that level or at that board level or that billionaire level, sometimes there's egos and there's there's hurt feelings and people feel like they were lied to or ripped off or whatever, and they want to send a message. And sometimes that message is they're okay with it being a zero. And I think that's what you're seeing play out here. I think it's great that Regeneron made an offer. I hope the founder, if it's a good offer, gets the right offer because it's a higher number than what Regeneron is offering. But it's a good warning that if you're a founder that loves your business, you want to bootstrap as long as you can and not get seduced by that large market cap or that IPO, because the VC is going to hit the eject button if they don't think you can deliver. And that's just the bottom line. It's like, if they don't think you can hit the growth or the margin, they'll find someone else who can. And you see it how, in some of Hallie's research where, founders have like 2% of the equity by the time it IPOs. Like, either you're diluted out or you're ejected long before you get to the exit. And I think that's the other, probably frustrating piece for people in the space is,
Well, by the way, I think we all saw the Titanic irrational clash of billionaire egos in HBO's Silicon Valley as we followed the adventures of Gavin Belson, the CEO of Hooli, and Peter Gregory. And Gavin Belson was modeled on Eric Schmidt, and Peter Gregory, the eccentric billionaire investor, who was modeled on Peter Thiel, and Russ Hanneman. I'd like to know who Russ Hanneman, maybe the most memorable of all, who was just an incredibly obnoxious billionaire investor, and I wonder who he's modeled after. But I would have thought that would never play out in some part of healthcare. But it sounds like you're saying that maybe it does a little bit
well,
after
and
all.
what you have to realize too is I think when you're that level of person, your time horizon for a turnaround is different than I think most, say, institutional investors. Like if you're a board member or you're someone who's an executive at a company, you're probably thinking, hey, I got 10 years to turn this around, or I'll wait. I can wait. I'm not worried. And like the problem is you always run out of time. When the stock gets to a certain point, you always run out of time because investors will target it. And so it's also, if it's not politics, it's a disconnect of perspectives or incentives that leads to this happening in healthcare. Like my point is, what's forgotten is there is a fourth fiduciary here, and that's the patient. And I think a lot of times we in these situations forget, hey, what happens to this business if it's a zero? Like, what happens to the patient? And that's really the most important question.
Yeah, and you saw that. I was at a juncture where I was absolutely intrigued by the 23andMe products, and I bought the tests, and I thought of taking the test, and I was going to take the test, and you pay to buy the test. It arrives as a kit, and it was sitting there on my desk. I was too busy to take the test, and then the story of the Golden State Killer being identified through DNA pathways happened, and that gave me pause, and I still didn't take the test. And I ultimately never took the test. I paid full price for the kit to arrive, and then never took the test. And it was that, hey, maybe it's a good thing that the California State Police used obscure genetic databases to track down and find the family tree of the killer and ultimately pinpoint him. Maybe that's a good thing. But then my data is in this database forever, and who knows what's going to happen to it? Could be the company. It never actually occurred to me the company would go bankrupt and sell it as one of their primary assets, to the highest bidder. So anyway, well, we just some comments here. Joe writes, "Love that show, Trey's commas." Yes, thank you, Joe. And by the way, Joe, I think last I checked, you can actually buy Trey's commas tequila, worth buying as a conversation piece. And then we also have. I put a link to the videos of A Healthcare Z, Eric Bricker, in the chat. And then Joseph says, I've tried ChatGPT and Gemini to test accuracy in their medical advice. It's impressive, but it still needs some oversight because of hallucinations. Thank you, Joseph. And then, let's see. Joe asks, what are the disease areas and interventions which will receive the most investment attention in the next 12 months? Any forecasted breakout areas? So there's two huge buckets here. One is conventional interventions, and the other one is digital health interventions. And I'm going to focus my answer on the digital health interventions. And what I think is going to happen is that the market of digital health interventions is mostly an employer and payer market to buy solutions like Teladoc, Livongo for diabetes management. Omada I think has hypertension management. Hinge has musculoskeletal management. There's other ones. There's cancer symptom management. There's autoimmune. This is from the employer perspective. There's health, wellness, and fitness, which is a little different. That's not disease management. That's wellness. And there's mental health, behavioral health. And What I think is going to happen is, and I named the big categories right there. And what I think is going to happen is that you're going to see a massive rebuild of this sector. So you're going to see new companies founded. The market has matured. We know what buyers want in this market. We know what the big product categories are. And then you're going to see AI native companies take off, and they're going to have 30 US employees and 100 employees overseas, and then they're going to rebuild everything using AI. And so instead of having 10,000 employees and rebuilding everything, they're going to rebuild everything using a minimum number of employees, and they're going to rebuild these products. And then there's two things we know about AI native software companies. The first is that you can build the software quickly with fewer people, and the second is that they often have interesting feature functionalities that the prior tech stack can't duplicate. If you put AI central, if you put a large language model central to the feature functionality of the product, not just constructing the product, but to the functionality of the product. And so, and a lot of the existing incumbents, those unicorns built on the old tech stack, they don't have the cash today to just copy that. They don't have the cash to do it. And so I think you're going to see a rebuild in digital health of those kinds of products in those areas that I mentioned. And you're also going to see this in the B2B productivity stack. So the world of Google Workspace and Microsoft Office Productivity Suite and Oracle's CRM software and that sort of thing. You're going to see there's an opening, and in the world of B2B, not healthcare, you're going to see a similar thing happen there faster, actually. So, Steve, any thoughts on that question?
Yeah, no, it makes a lot of sense. I think, it's a great question for hims and hers. Like what comes after GLP-1s? I think, and actually they're an interesting case because what's interesting about them is they've solved not having to go through a payer model to generate gobs of revenue. So if the person asking knows what indications they think are coming, maybe they have a business opportunity there.
Yeah. So, by the way, there's an interesting angle on hims and hers, which is that so very often they're offering products like a drug for erectile dysfunction that you can get. You talk to a provider. You go to hims and hers. You engage with a provider. The provider writes a prescription. Hims and hers fills a prescription. You pay, often out of pocket. Maybe you can get reimbursed later, maybe you don't get reimbursed later, but they found people who want this. They want the immediacy, they want the anonymity, they want to just get the drug, etc. So the irony here is that your physician has built a relationship of trust with you, and your physician would love to have a conversation with you about erectile dysfunction, or getting a test for a sexually transmitted disease, or about your male pattern baldness, or about your emergency pregnancy test, or about whatever. Your physician is waiting there and has invested in you and would love to have that conversation with you. And instead, what you want to do is you want to go anonymously on the internet and text chat with someone you'll never meet and tell them that you need a drug for erectile dysfunction, and then you want to get the drug in the mail. And so it's ironic that your doctor got a invested in a major medical education, invested in a relationship with you, but people don't want to go to their doctor for that and get it reimbursed by their health plan. They want to go anonymously and then pay for it out of pocket. So anyway, that's what hims and hers discovered.
Privacy and convenience. There is a price. What's the right word? There is an intersection point of privacy and convenience that people will pay out of pocket.
Yeah. Well, so I covered some of the last comments in the chat, and so Steve, any last words before we sign out?
Just thanks for having me. And I think, it's great that we're seeing some IPOs. I think, hopefully it's better days ahead for the space. But, there are pockets that I think are delivering a lot of care improvement, a lot of value, despite some of the negativity you may see from people who follow the macro. And you just keep at it.
That's great. Well, that's great to hear. Well, so you've been listening to the Digital Health Investor Talk show with your host, Steve Wardell. So many thanks to our guest, Steve Rubis of Access Telecare. Thank you, Steve.
Thank you.
So we'll be publishing this show as an episode of the Digital Health Investor Talk show. Subscribe on Apple and Spotify. Don't forget to rate us. We love 5-star reviews. And for our Boston audience, we have on June 12th, we have Claire Smith of Springtide Ventures speaking on new investor themes within healthcare AI. So thank you, and I'll see you there, and see you on the next show. Bye-bye.